It's Thursday, the 26th of January, and here we are.
Here we are. You're right. January's over next Tuesday, I believe. I believe it carries into Tuesday, and then we're into February.
We had a discussion on our show this morning. What do you think the Fed's going to do in February? Is it going to be a 25 basis point increase or a 50 basis point increase?
We both said to each other and said on the air, we believe it's going to be 50 basis points. It was our reasoning behind it was another discussion that led into that question. Does the Fed have the attention and the control of the market, meaning stock market, that it wants to have? And
I don't think they do. I think that every time that they raise rates, there's a lot of squealing going on, and they think that the squeaky wheel is going to win out. And I don't think that the squeaky wheel is going to win out because there's an old adage: never fight the Fed.
No, you don't. And so with that, a 50 basis points would be, with the market anticipating a 25, if a 50 basis points increase came in next week, and it is next week that they're going to have the meeting and the announcement, that might be a swing with a bat that might get the attention of the market, and that might get the Fed to where they want to be back in the driver's seat of control.
Don't you think that a 50 basis point increase would rattle, at least slightly, the markets because they're anticipating a 25 basis point
Yes,
increase?
yes. The market's anticipating 25. More and more you hear is 25, 25, 25, and then a pause. If it was a 50, 25, 25, then a pause, then that would be different, and that would get the market's attention. And again, we are firm believers that the Fed doesn't have the attention in the market and wants to get attention. Data numbers are mixed, but data numbers are still good. GDP numbers for fourth quarter came out, and it was above expectation,
right,
just by a little bit, but a 2.9% GDP number.
Yes, and I think that'll be probably the high water mark for a while. I think GDP will begin to decrease first quarter of this year, second quarter of this year. Earnings will begin to decrease, and all of the hard data that they've been looking for a recession will come to fruition. Now, we're not hoping for it, but that's what we're anticipating, and that we have your portfolios aligned for that.
Now, it's projected that the first quarter, second quarter, or second quarter, third quarter 2023 are going to be negative numbers. Now, here's an interesting question to think about. If fourth quarter 2022 just came in at 2.9%, what will happen to the economy and to the market if the first quarter 2023 is a negative number? Now, we've gone to 2.9 down to negative. What do you think the shock effect would be?
Oh, it would be huge, and I don't think that that's going to occur.
Okay, so what do you think the Fed then will do? If it doesn't occur, they might have it declining, but it's not where they want it to be yet.
Yeah.
They're going to continue to raise interest rates.
Yes, if not 50 basis points in February, it'll be 25, and it'll be an extended period of time for 25 basis points.
All right, so this is not exact, and this is just a picture. We were this far away from saying here last year it's time to move into the marketplace. We're moving into that, but we still think we need to hang on because of the very things in which we're saying. But we are getting closer, and you are getting rewarded for having money in the treasuries at the 4% and 5%. And the thing we've been seeing is institutions have finally begun to tell its institutional people that you should be doing that. And so we're kind of patting ourselves a little bit on the chest that we're where we need to be, but let's hang on because of the very things we've been saying.
We're getting 467, at least in today's numbers, on a 3-month Treasury bill.
Right. We're going to continue to review. We got our list, as we've been saying. I went into Gibbs' office the other day and said, how you doing on fine-tuning that? And he's fine-tuning it, and we're looking at it. And we're also got monies coming up in January, February, and we're renewing those probably for another 3 months. So we're exactly where we want to be at this point in time, where the market is, and we feel good about it.
Yep. So look, you'll see probably in January and February, as you just said, the maturity of some 3-month and 6-month Treasury bills in January and February.
All right, and we probably are going to buy another round of them. All right, call us if you have any questions. We're off to a good year. This year will be a good year regardless of what the market will do, and we're here for you. We appreciate you always, and we do it because we know it is your money.
And your money matters.
See you next week.